ebook on supply and demand. This is my 5th or 6th video of the batch I've been doing. I'm probably going to take a week or 2 break after this, but this is a really good ebook. I'll link it, but there is a lot of shit that you need to just ignore because he's obviously selling this ebook. He needs to pad it out. He needs to make his 26 pages to somehow sell it or whatever you want to call it. So I'm going to be cutting through it all, taking out the bullshit and getting it all done within maybe 5 or 6 minutes. So ignore the introduction. We're going to first say what they are. So supply zones are caused by strong sell-offs by banks. Essentially the idea is that if they don't get enough of their sales filled due to insufficient liquidity, they're going to bring price back up, but they won't break their old sell zone because they don't want to put their existing sales in jeopardy or into drawdown. So they keep suppressing price while getting the more sales filled, and then will continue to move price lower. So here's an example of a sell zone. And then he's also gone off and said why sell zones won't work. So he essentially said that this was a supply zone created, banks took profits here, so supply zone was basically void. And the reason why this is because this took 11 days. Supply zones should be filled in 24 hours on smaller time frames. So we'll see that there, 11 days. This should have been filled in a much shorter time frame, and they've realistically taken profit and they've shifted into long positions. Apologies. Okay, sorry about that. Here's an example of a successful one. It looks like this was some high impact news based on the wick. This is a supply zone here, got fully taken, and he's going to say, I think he says that was in a couple of hours rather than 26 hours instead of 283, and this one here. And yeah, I was right. It was farm payroll, and you can say that these news events are complete gambles, but don't worry. The banks have both scenarios accounted for. They've placed orders either direction that's going to benefit them, and they'll move price in whatever way suits their orders. So in this instance, they've placed their sell zone. They placed more sell orders in the supply zone, and it's suppressed price. Now here's a failed demand zone, which is the opposite. It's when banks are buying, and if they don't get enough buy orders in, they'll move price lower to fill more buys. However, he's then gone off and said that this didn't get filled within the given time frame, and when price did move down to the demand zone, it broke because the banks have no incentive to keep price moving higher as they've taken profit up here. Now then he says how long should it take? He says general rule of thumb is 20, like a day or day and a bit. But then he says in different time frames it's different. So on the daily it could be 30 days. On the hourly, it could be 24 hours, and then he says large moves can take up to 2 weeks. And then he says why, and then he's gone into saying exactly what we've said, except he's also then said these zones can be caused from taking profits, and he's basically just saying there, remember, if you're long and you want to sell, if you want to take profit on a long, you're selling the asset. If you're short and you want to take profit, you're buying the asset back. And he's basically just said when banks take profits in bulk, those can also create supply zones. And if they don't get enough of their sales taking profits on, then they'll make price move back up to their supply zone so they can sell more, and vice versa. If they want to sell more of their buys, they'll bring price lower again. Or, sorry, I've got that mixed up. If they want to take profit on more of their buys, they'll bring price up into the supplies. Well, the supply zone will be created because they'll be selling off their buys, so they'll be creating a supply zone. I'll show it here. So yeah, say they're a lot, and you know this because in these conditions, if price is moving up, they're taking profits on their buys. If price is moving down, they're taking profit on their sells. So you can hear they're long, moving price up, they're taking profits. Not all their position has been filled, so they're going to take profits here again, and for a third time, and they're going to keep doing this as we're in an uptrend. And this is an example of them taking profits on shorts because it's in a downtrend. Then he says, how do you know if it's caused by creating trades? And he's basically just going to say, because the highs aren't broken, because they don't want to jeopardize existing positions, because they've got millions, they don't want to go into drawdown, etc, etc. Not important. No, not important. And then he just goes on to reiterate that this took too long, therefore they didn't pass. And then whereas on the other hand, this was successful because they were filled within a very short time frame. And then he says the reason why some people think that old supply zones actually cause reversal is because these short-term positions are actually these short-term supply zones that they think are supply zones are actually supply zones on like a larger time frame. Or the same with demand zones, because this is I'm gonna have to read this briefly, but in other words, a zone on the 1 hour chart is 24 hours. So yeah, he's basically saying that this is the daily. I think the large green is the daily, but these are the hourly. So in reality, these technically shouldn't be demand zones because they're too far apart. However, if you go on to the daily, then you can see there. See, he said it here. Daily, we can see there are 3 1 hour ones, but that's one big one on the daily. Same with supply. So he's basically just saying, and he says here again. Look, old demand zone. This is the hourly chart. However, if you were to actually flick onto the daily, this would be a valid demand zone. So essentially, he's just saying don't get confused between old demand zones that seem to be working. It's because more than likely it's a demand zone that's actually on the daily. So we're just going to read through his summary. Supply zones and demand zones form because banks have taken profits because they've placed trades. Zones form at the beginning of reversals, have a market return to them because the bank like to get all their trades placed at similar price. We said that. Rally-based drop-based rally, supply and demand zones have a higher chance of causing the market to reverse upon being hit than. So that's basically this here. This versus this. So, except this is the opposite. This is drop-based drop. Drop-based drop. It's just the reverse. It's not that important. I don't even fully understand what he's trying to say here. Anyways, if a supply demand zone is going to cause a reversal upon being hit, the market must return quickly. So saying if it takes too long, it's invalid. And he says the time frame, and he says old ones don't work. More likely they're just inside a higher time frame. So yeah, that's basically the whole 26-page document summarized in about, I don't know how long this video is. I'd say it's about 8 minutes. I'm going to link it down below so you can have another read. I know I went through that very quickly, but it is still a very good ebook. Hopefully this has helped you guys, and this is going to be the last video for this evening.